Ladies and gentlemen, good day and welcome to Windlas Biotech Limited Q4 FY23 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Hitesh Windlas, Managing Director at Windlas Biotech Limited. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us today for our financial results for quarter and full year ended March 31st, 2023. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope everybody must have gotten an opportunity to go through it. Initially, I would like to discuss the outlook and way forward for Windlas Biotech, followed by financial highlights for Q4 and FY23, which will be shared by our CEO and CFO, Ms. Concall Gupta. The overall Indian pharma market grew at around 9.3% in FY23, while Windlas grew at a slightly faster pace with revenues growing 10% for the fiscal. I am delighted to announce that the company continued to achieve growth across various operational and financial parameters, notwithstanding the challenging business environment of low IPM volume growth in most of the therapeutic areas. The company's focus on operational excellence, strict cost management, and customer satisfaction has enabled it to maintain its profitability. In line with our goal of creating value for stakeholders, company has successfully completed its share buyback, generated healthy operating cash flows, completely utilized IPO proceeds, paid a dividend, all while maintaining a healthy liquidity position. We have utilized the complete proceeds raised for injectable facility by March 23, and plant construction is in full swing. As mentioned in the Q3 earnings call, we expect to achieve mechanical completion by end of Q2 of this fiscal year. As guided on multiple occasions in the past, company is actively looking at prospective inorganic growth opportunities to obtain synergies, diversify its product line, and achieve scale. The company has a healthy liquidity position and is well placed to seize these opportunities. Looking beyond the short-term challenges, which are transient in nature, we remain sanguine about the overall Indian pharma market landscape. We are witnessing multiple green shoots in all business verticals in which the company is present. Company's unique value proposition and strong customer connect makes the company well positioned to achieve its long-term goals sustainably. I will now request Ms. Concall Gupta, our CEO and CFO, to discuss the strategic and financial performance highlights. Over to you, Concall.
Thank you, Hitesh. Good morning, everyone. The company delivered healthy operational and financial performance with its highest ever revenue and profitability quarter and year. We have recalibrated our focus on key strategic priorities with a renewed vigor. We will continue to take all the efforts for increased reach, profitability, and efficiencies across verticals. The company remains committed to its predetermined strategic objective for its generic formulations, contract development and manufacturing organization segment, that is CDMO segment. The strategies involve the detection of products that are encountering an upsurge in demand and concurrent broadening of markets for the said products, procurement of novel customers, and augmentation of revenue from company's current customer base. Financial highlights for CDMO vertical are for FY23 and Q4 FY23. Revenue for CDMO vertical stood at 398.3 crores and 110.4 crores, up 5% and 14% YOY respectively. CDMO vertical contributed approximately 78% for both financial year FY23 and Q4 FY23 respectively to the consolidated revenue. The company's domestic trade generics and institutional vertical is experiencing rapid growth, which can be attributed to the company's strong distribution network. We continue to execute on our strategy of providing accessible, affordable, and authentic medicine to underserved small towns and cities. The growth of the domestic trade generics market in India is expected to be propelled by government initiatives aimed at promoting the adoption and reliance on generic drugs. The company's primary focus is on enhancing brand development, refining marketing strategies, exploring new distribution channels, introducing innovative products, and expanding into unexplored territory. Financial highlights for trade generics vertical are: for FY23 and Q4 FY23, revenue for this vertical stood at 90.5 crores and 22 crores, up 49 and 50% YOY respectively. Trade generics and institutional vertical contributed approximately 18% and 16% for FY23 and Q4 FY23 to consolidated revenue. The company continues to work towards exports vertical, such as filing of numerous dossiers and entry into newer semi-regulated markets. Financial highlights for exports vertical are: for FY23 and Q4 of FY23, revenue for exports stood at 19.8 crores and 7 crores, down 5% and 26% YOY respectively. This vertical contributed approximately 4 and 5% for FY23 and Q4 of FY23 to the consolidated revenue. Let's look at the consolidated financial highlights of the company. For FY23, consolidated revenue, EBITDA and PAT grew by 10%, 15% and 12% to 513.1 crores, 60.2 crores and 42.6 crores respectively. For Q4 of FY23, the same stood at 140.7 crores, 16.4 crores and 11.4 crores respectively. Gross margins for FY23 were 160 bps higher YOY at 36.6%, and EBITDA margins were up by 50 bps at 11.7%. Gross margins for the quarter were 191 bps higher YOY 36.8%, and comparable EBITDA margins 40 bps higher at the quarter end. EBITDA margin increased to 11.7% from 11.3% YOY in Q4 FY23. In line with our goal of creating long-term value for all our shareholders and stakeholders, the company announced a buyback for 25 crores in third quarter of FY23. I am pleased to inform you that the buyback has been completed. Furthermore, a dividend payout of 7.6 crores, that is rupees 3.5 per share, related to FY22 was disbursed to all the shareholders during the year. At the end of the FY23 fiscal year 23, the company had a strong liquidity position totaling rupees 138 crores and generated a healthy net cash flow from operations of rupees 61 crores. The company has also utilized the entire proceeds of 165 crores obtained through IPO on the stated purposes that were outlined in the prospectus. That's all from our side. We can now begin Q&A session. Thank you.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Yogesh Tiwari from Arihant Capital. Please go ahead.
Yeah, good morning, sir. Am I audible?
Yes, you are.
Yes.
Yeah. Thank you, sir, for the opportunity. My first question is on your on the upcoming injectable facility. So we are expecting about like 1.3 times. We have invested about 50 crores, and we would target about 70-80 crores from this facility, 1.3 times asset turnover. So, what would be the timeline like? By when can we achieve those numbers?
So, Yogesh, it's difficult to give an exact timeline, but I can tell you some actions that we are taking. We have already introduced some injectable products in our trade generics vertical. So we are growing those in volume. So we believe that some part of that, when it comes in-house from our own unit, will add to that. There is, I mean, as a new business, however, it will serve all our three verticals. So CDMO, where we will have to get it approved by each customer. Exports, where we will have to take dossiers once we have the WHO GMP. My sense is that any new dosage form, starting from scratch like we are, probably a good, time frame is around 2.5 to 3 years.
So, sir, from September onwards, when the mechanical work will be over, so will this commercialization start, or it will take some more time from September, the injectable facility? So,
since the injectables are sterile products that are put into the body directly, there is a huge amount of qualification work that goes on after the injectable. So this is called as media fill and validation. And, this can take anywhere from, 4 to 6 months. If you are lucky and everything happens in first shot, it can be 4 months, or if it is, outer side, I would say 6 months. So this is where, that activity we will be launching into. And thereafter, we are hoping that in this financial year, we are able to at least make, the first commercial batches out of the plant.
And sir, this will be entirely in the initial part will be entirely for trade and generics.
No.
For this,
the injections that we manufacture this facility will serve all the three verticals: the CDMO vertical, trade generics and institutional vertical, and also the exports vertical.
Okay, but currently we have not received any approval inspection from CDMO clients, right, for the new facility, injectable facility?
No, Yogesh. So what the process of this is to finish the facility validations, then the customers will come and audit it, then the regulatory authority of different countries will, will submit the dossiers. So it's a sequential process. Without having the facility ready, we cannot get the approval.
So just for modeling purpose, like the major revenue contribution would come from like FY23 onwards from this facility. Am I correct?
Yeah, I would say major, you can assume FY25 onwards.
Sure, sir. And sir, the margins of injectables are higher. So what would be the premium on, like, if we have like 11.5% EBITDA margin on a consolidated basis? So what would be like an approximate premium to this margin from injectable facility?
My sense is that typical injectable businesses should, give around 18 to 20% EBITDA. But that should happen at, optimal capacity utilization. So this is what we will be trying to reach towards as soon as the facility is, ready to manufacture. But yes, the expected margin from injectables is significantly better than oral solids.
And so this optimum utilization would be 80% approximately for injectables?
My sense is that, anywhere, 55-60% optimum utilization.
Okay, sure. And sir, in terms of exports, what are the new dossiers which we are filing to expand the export market?
Yogesh, we are not providing the, product or market information due to competitive reasons. But there is the markets that we are present in, Southeast Asia, Africa, we are continuously adding products over there to increase our footprint and gain more mass in our exports.
And sir, finally on the capex program. So apart from the injectable facility, any other major capex we are planning for rest of FY24 and FY25?
No, we are not planning anything major, but as I said that our current oral solid facilities are able to, will support us till about 600 crores of revenue. Beyond that, we will, need one more expansion. So currently, my sense is that at least FY24 we should not need the expansion, but
for FY24 sales, we might not need. At the end of the year, we might have to be ready if we are able, for the next year.
Yeah.
Sure, sir. That's all from my side. Thank you very much.
Thank
you. We have our next question from the line of Raghav Vedanarayanan from JM Financial. Please go ahead.
Yeah, hello. Am I audible?
Yes.
Yeah, hi. Good morning. So a couple of questions from my side. So first is regarding the domestic business. Can we get some guidance and like a breakup for the CDMO and for the trade generics business? And second question is, so the gross margins have been improving. So would this be a sustainable number, or how should we look at this going ahead? Thank you.
Raghav, sorry, we did not understand first part of your question, the first question.
Yeah, so first question is if you can get some domestic guidance and also like a split of the CDMO business and the trade generics, the guidance for both of these.
So rather, we are already providing the segment-wise revenue with the three verticals, right? You are asking for separate segment-wise guidance.
Yes, correct.
So rather, we are not providing separate segment-wise yearly guidance. As a long-term goal, we have said, that our idea is to double the trade generics business, double the CDMO business, triple the trade generics business, and quadruple the export business. In some cases, we are ahead of the curve. In some cases, we are a little behind. But that is the, long-term guidance that we are still maintaining, our efforts towards.
Okay, so is there any timeline for these goals?
Sorry, could you repeat?
Raghav, can you use your handset, please?
Yeah. Is there a timeline that you have in mind for these targets?
Yeah, so I think 4 years is what we are looking at from the current. In 4 years, we are expecting to go there. The base of double, triple, and quadruple was FY21 numbers. We were originally we were thinking of reaching there in 5 years. Now we think that we are a little behind by about a year.
Okay, and also the second question is regarding the gross margin. So there has been an uptick for this year. So is this trend sustainable?
Yeah, so the current EBITDA margins, they are also the material margins, they are sustainable ones. There can be some upward trend with the mix of the kind of sales happening, like trade generics, exports. If we are able to increase them as a percentage of total sales, and also with injectables infusion, there can be an upward trend in this.
Okay, thank you so much.
Thank you.
Thank you. We have a next question from the line of Naman Bansali from Perpetuity Ventures LLP. Please go ahead.
Hi, sir. Just following up from the previous question, during the IPO, we have guided about various verticals like doubling and quadrupling. So this implies almost doubling of the total revenues from a base of FY21. And as per your previous answer, you are telling that it is delayed by 1 year or so in terms of achieving the guidance. Now, as per FY23, where we are standing today, this implies almost 17-18% growth based on the 4-year projections that we are taking. So where do we stand at on a today on a company level basis? Are we able to confidently grow on that trajectory? That is my first question.
So I think, Naman, couple of things, in the past, if I look at the past data, there have been years where we have grown, in single digits, and there have been years where we have grown, 20% also. And I'm not just talking about COVID past, I'm talking about, almost like, let's say, 10 years history. So I think it's important to understand that what are the underpinning factors, external factors that influence growth. On the domestic CDMO side, the volume growth of the overall pharma market is a representation of how much our customers are going to buy from us in terms of volume, right? So that's an important number, and I believe that there is signs of recovery happening. If you look at the last couple of quarters, the volume growth almost across therapeutic areas has improved. First 2 quarters was very poor if you left antibiotics out. So there is my sense is that if overall Indian pharma market volume grows, we will be able to utilize that momentum and do better. In terms of new products associated growth, again in CDMO vertical, we are launching several new products. Number of DCGI permissions that we are getting has increased significantly from what it used to be last year or even before that. So these are all the ways of driving faster implementation, greater customer connect, and improving product match with customers. So CDMO is driven by that. Now, as a small company, we are trying to see how we can outperform the market and grow faster. So that's definitely the mandate of the whole team. In the trade generic space, you can see a different trend. We grew almost by 50%, right? Although it was a smaller base, but that growth is coming from our execution and our engagement with our distribution channel, our umbrella branding that we are doing for generic Windlas generics across the space, and our much better execution because of our unique distribution structure, where we don't have large distributors as intermediaries. We are working with almost 600, 700 stockists directly across India, and we are able to do it because of the way we have built our IT system. So this is something that we are looking to capitalize and see how fast we can go. If you look at my guidance on 4-year guidance on trade generics, which is to triple that number from FY21, we are most likely going to exceed that, right? If we are able to maintain this kind of a momentum. And I see no reason to not have a strong momentum in this vertical. On the export side, this is where we have some work to cut out for us in terms of bringing in launches for dossiers that are already approved or have recently been approved, and also initiate new countries. This is a slightly longer or fag-ended kind of a growth that you will not see in every year, but we are hoping that it will line up by our 4th year. That is what we are aiming for. So, the commentary that I can provide is that each of these 3 verticals have a different path to getting there, and a straight line path may not be there. Some are more driven by volume, and some are in trade generics. We are participating in both price increase as well as volume increase, so we are getting a better benefit there, and so on and so forth. I hope I've been able to answer your question.
And also just to add, in case we are able to catch up through trade generics and export verticals for the overall number that we are talking about post 4 years, we would be happier in that sense, because they are better profitability and better control verticals for us.
Got it. Second question is regarding we've seen a sharp jump in the other expenses this quarter. So where exactly are we seeing the increases coming in from, and what is the base which we can assume going forward these other expenses can grow at?
So the expenses were higher in the other expenses. There was a higher research and development expense, power and fuel. Because of a very high sales quarter, there were also increase in selling and distribution expenses, production and testing related lab testing expenses. These are the various expenses that were on higher side in this quarter. Not necessarily all the expenses are quarterly equally distributed, and there are a few which are linked to the higher sales. So in terms of trend for going forward, it's better to look at the year number instead of a quarter specific number.
Okay, that's it from us. Thank you.
All right. Thank you.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Gaurav Gandhi from Glorytail Capital Management. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. Sir, how do you look at the export market in the coming year?
Gaurav, thank you. I feel, I'm very, bullish about exports, from India to ROW especially. We have seen that the developed markets across the board are facing very, very high customer consolidation and erosion of, margins. And some companies are in the developed space are doing better by launching new products, difficult to manufacture products, and so on and so forth. The ROW space is a different space, and in the rest of the world, which means Southeast Asia, Africa, CIS, Middle East, and so on, this space does not have very large batch sizes, and the number of SKUs required to serve a country with small batch sizes is very high. So it has a natural advantage for a CMO player like us, which are used to manufacturing a very large variety of SKUs, and that internal competence is built into our DNA. So, we are really looking at it from this perspective of although it is slow to build, but better EBITDA, better, exposure, and such. So, if you ask in terms of my subjective assessment, I think this is definitely a very, good area for the company.
Yeah. And sir, so if we are focusing on semi-regulated market, so what if the regulations become more stricter? Will it be a risk for us to grow our exports in that area?
Yeah. So that's an excellent question, Gauravji. We are actually looking at, the semi-regulated market from our facility, which is EU GMP approved. So in some sense, I can say that we are already, serving these markets from a high-quality facility, and we should not face a sudden risk of that type. So overall, it will be a mix of things from different facilities, different markets. But in all our facilities, also we are upgrading. We are bringing the electronic systems, EQMS, EDMS, e-learning management systems across the board, and we are building this capability and competency at the ground level to look at future, not only in exports but also within India, and be a leading quality recognized name for everything that we manufacture.
Right, but ये ऐसा कुछ sudden risk जैसा नहीं आएगा ना, अगर कुछ रेगुलेशन बढ़ता है या कुछ होता है तो सडन रिस्क अपनी कंपनी को होगा, या ऐसा कुछ बता सकते हो आप कि वह रेगुलेशन कोई कंट्री में बढ़ गया जहाँ से रेगुलेटेड कंट्री जहाँ हम एक्सपोर्ट करते हैं वहाँ पर अचानक से कुछ रेगुलेशंस आ जाते हैं, तो सडन रिस्क अपने एक्सपोर्ट्स सेल्स को हो सकता है इस केस में?
नहीं, देखिए जहाँ तक मेरी अंडरस्टैंडिंग है गौरव जी, वी आर नॉट एक्सपेक्टिंग एनी सच सडन रिस्क.
Okay.
This is as per my understanding.
Okay. And sir, can it be the case that because we are not in the API manufacturing process, clients might prefer some other leading players who provide CDMO plus API?
So, even the largest manufacturers in our space are unable to achieve perfect vertical integration because of so many molecules, so many dosage forms, and such a very wide variety of SKUs. So my sense is that and that's why Windlas is also not chasing the biggest volume contributors. We are chasing value which is between very small and very large molecules, somewhere in the middle. That's how we are looking at building our portfolio. So my sense is that the vertical integration will have only marginal benefits in the business that we have.
All right, sir. And the last question is, sir, what is your vision for the company, or say where do you see this company 10, 15 years from now? Where do you want to take it?
So, in the long-term vision perspective, we want to be a very large player in India, having our own production, our own generic sales force, being present in all the institutions, both in various dosage forms. Currently, we are only doing oral solids and liquid. Injectables will come, and many other dosage forms are there. We want to be a player whose sort of three values of authenticity, affordability, and accessibility are seen by all our patients as well as customers who we work with. That is one of our very important aspirations. We will continue to serve our B2B customers and grow with them. And we will have one of the most modern facilities that are able to serve the increasing requirements of quality in this space. And we want to be a supplier of choice. So, most of what I'm saying is, taking our efforts and objectives and growing in scale. So that scale is very important while maintaining quality, for us. So that's how we look at, next 10 years or so time frame.
That's great, sir. All the best for the future. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Dipti Kothari from Kothari Securities. Please go ahead.
Thank you for the opportunity, sir. Sir, my first question was that do we have any updates on inorganic opportunities front?
Dipti, we have been evaluating several opportunities. And in some cases, we did not move forward because of the quality of the plant or the quality of the business. We are being very selective because we know that as a company which has very strong operating cash flows as well as a good liquidity position, we are in space to do a good thing. And so we are being selective. So there's no immediate something that I can say, is happening, but we are evaluating many ideas and many opportunities.
Okay, sir. And so what is the current market share in the domestic CDMO space of Windlas?
My sense is that we would be somewhere in the range of, I think we did the study at the time of the DRHP, where the market share evaluated by the external consultant at that time was somewhere in the range of 1%, because it's a very highly fragmented market after the first two players. I don't think anything would have changed drastically from then.
Okay. Thank you, sir.
Thank you. A reminder to participants to press star and 1 to ask a question. We have a next question from the line of Akash Mehta from Kapaz Investments. Please go ahead.
Hi, good morning, sir. My questions were around the export business. So just wanted to know what are the key reasons for the decline in the exports vertical, and how do we anticipate this outlook for the segment in the coming years?
I think the base that we currently have, which is about 18 to 20 crores of sales, is too small, while to say, whether there is a uptick or downtick on this right now. Some of our exports we could not ship because the customer was unable to renew their import permit in Myanmar. And some, in some countries, last year we also had some challenge. We stopped some sales to Sri Lanka when, Sri Lanka went into the foreign currency crisis. So, some of those things are like that. But I think the growth we are looking for is going to come from not just the existing markets, but also new markets that we are trying to open. Eventually in the next couple of years time frame, injectables will also play a very important role in bringing us access to these ROW markets, because almost most of these ROW markets don't have any local manufacturing in injectables. So as I mentioned earlier also, the procedure is a little lengthy one. You apply, you take the batches, you generate the data, the dossiers, then you apply to the regulatory authorities, and it takes about 1.5 to 2 years for approval of each product, and then you start the business. So that's why we feel that going to be a fag-ended vertical in terms of growth appearing on the top line. We are also looking at potential ways to accelerate this through inorganic, because it takes long time to build internally. So this is also another area specifically within our inorganic search that we are trying to see if there are opportunities to do that. So that's sort of the general commentary I can give on this.
Got it. Now, in terms of the new markets, just a sense on what is the proportion of the export market in terms of the regulated and semi-regulated markets, if you have any insight, and what is the anticipated ratio, if we can say, in the future?
So currently we are almost 100% semi-regulated, and in the near future, once our South Africa starts, so that will start contributing to a sort of a SRA, one of the SRA kind of a market. And as you know, our facility is EU approved. So we are also evaluating various projects for that geography. So I think that some of these proportions will shift as we go forward. It's hard to give a ratio or a number right now.
Got it. Incidentally, my last question was on the South African exports. So you had said in the Q3 call that you would be commencing that. So any updates on that front?
So, we have been following with our customer also, and they've been saying, 1 or 2 weeks, for the launches. So, we are just also waiting for that, their launch, so no further update. Other than that, what we have heard from our customer.
Got it. Thanks a lot.
Thank you. We have our next question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
Sir, So many congratulations for excellent set of numbers and also thanks for healthy dividend on top of a share buyback. Sir, I wanted to get your view that in your judgment for the current financial year FY24, sir, what kind of growth are we looking at?
We continue to work and put all our efforts to give the growth, but year-on-year growth, we do not really share any future-looking statements in that sense.
Sure, sir. Sir, one more thing that, sir, our injectable facility is expected to come on stream, I think, in the second quarter of this financial year. So till the time that facility is able to ramp up for the initial few quarters, sir, should the shareholders be expecting any losses? Or sir, when exactly will this break even?
So one thing that we are thinking of doing is once that facility becomes operational, we will try to separately provide, the EBITDA, that is being affected by the losses from that facility. For sure, anytime you start a new facility, there will be a small operating loss. At the same time, we are also working to tie up that capacity and see how fast, how can we minimize that period. So, we will try to give visibility as soon as that number starts to become part of P&L, so that there is clarity and all shareholders are able to transparently see everything.
So much appreciated. Thank you very much and best of luck.
Thank you.
Thank you. We have a follow-up question from the line of Naman Bhansali from Perpetuity Ventures LLP. Please go ahead.
Hi, thanks for the opportunity. So just one question on the slide 23, the client concentration side. So is it as a percentage of the overall revenues or as a percentage of some CDMO revenue?
Overall. It is as a percentage of overall revenue, yeah. We have been, so all the comparable numbers are as a percentage of total revenue.
Okay, and we see that in 2028 there is a very sharp decline in these percentages. So would you like to speak anything about what sort of customers are being added incrementally and this concentration risk going down? And secondly, I think on the above slide, on slide 21, there have been a sharp increase in 2023 in the number of generic formulation CDMO products too. So would you like to speak on these two points?
Okay, so let me take the question on slide 21 that you mentioned. The sharp increase, see, anytime we add an SKU or a customer, the customer doesn't give us the largest of their brands or the most important of their SKUs, right? We engage and then, they try us out for a few SKUs, and as we, deliver the right supplies at the right price with the right service, then we begin to grow. So this process of adding new brands is like a nucleation and growth process. So we add that and then we look to improve volumes on those that we have added, and on those accounts where we can find traction, we then look to get the larger brands from those accounts. So this is a sort of a nucleating phase to increase the footprint, and then adding harvesting phase to get the business on board. So that's how this business moves. So the growth in SKUs is essentially a representation of that. And what was your first question, Naman?
Lowering client concentration.
You want to take that?
42%. Yeah, so we have been consciously working to lower the client concentration from top 10 customers, and this is more by increasing the number of customers, revenue coming in from the new customers, and So with a conscious effort this year, the results are there. So while we have been increasing the number of new customers, we have been able to increase the revenue from the new customers increased in last couple of years to such a level that top 10% has gone down below 50%. So it is not a specific, like Hitesh was mentioning, in terms of products mining. It's similar in terms of customers mining. While there will be customers added in last 2-3 years and also in FY23, the revenue, it takes time to increase from that customer. They first introduce one product, they get the comfort, and slowly we are able to, increase the product portfolio. That is how we have been able to really see the growth also that we were able to deliver.
But it is very healthy, for us to have lower dependence on the top client.
Yes.
And in fact, we look at it as a health metric as to how much concentration of revenue is there in any vertical by the top customer. And it allows us the flexibility and reduces the mutual dependence. It also allows us to make sure that our resources in business development, product development are not just getting concentrated in one bucket or one basket.
Got it. And just a small question that over the last year, do we see any meaningful customer being added which can contribute significantly to our CDMO revenue or the overall revenue which we can expect?
So, we are working with 7 of the top 10 pharma companies in India. In the top, the next 20 and the next 30 companies is where we are looking to add more customers. And yes, there have been additions. We have not been specifically calling out, either customer names or product names as a matter of competitive this thing. But yes, there have been additions, and those are basis of what we are thinking about the growth, in the coming years.
Okay, that's it from my side. Thank you.
Thank you. We have our next question from the line of Miten Lathia from Fractal Capital Investments. Please go ahead.
Good afternoon. We've sort of seen very good traction on the trade generic side, and so thought that we sort of 3x our trade generics piece in 5 years' time. Given what seems to be working for us, A, if you could sort of get more granular about what is working for us, and B, would we want to now be more aggressive and say this can be a much bigger piece going forward for us versus our earlier?
Right. So, Mitenji, see, for sure, so let me first give some context on what seems to be working for us. We are actually doing trade generics in a different way. We do not have large distributors as intermediaries, and we work directly with stockists in every zip code that we are working in. So what it does is it frees up some margin that we then share with both the distributor, the stockist, as well as ourselves. And it also makes us visible, gives us the visibility, understanding what product is selling, how that party is working, what is his credit worthiness, what kind of products he's able to liquidate, how fast, and what kind of other opportunities of adding new products is available in that geography, in that space. So this is very valuable, and that's how we are driving our growth. The second part is that we are not, again, different to most trade generic companies. We are actually doing umbrella level branding of Windlas generics. So in selected places, so for example, if you were in Bihar and you were looking at a cinema hall, you will see some advertisements of some products and Windlas generics coming on that cinema screen. And these are these are some things that we are doing. There are some other things that we are planning, and our goal is to sort of be a umbrella brand over there. and over the long run, we want to build this. Now, going back to your first question about whether, looks like we will exceed our aspirational goal of 3x on trade generics, and I am absolutely sure that we will exceed that. And how to take it further? It has to, definitely grow in scale. We are even at 90 crores that we did last year. We are very small fraction of what the largest player in this space is. So easily there are companies operating at 1,500, 2,000 crores in trade generics. So there is a huge amount of growth available here, and that is what we will be gunning for.
In terms of management bandwidth itself, given that exports is long gestation, slightly difficult, versus trade generics being something that we have already figured out, already giving us growth and cash flow, would we not then sort of be better off focusing our resources on that, or you think both are possible?
So, both are possible, Mitesh, because, just like, the bandwidth is also not very continuous or high demand in case of exports. You take the batches and you file the dossiers and there's a waiting period. And it's a different set of resources, the technical people who are doing that. On the trade generics, it is more the business team which has to execute. So it is not a competing in demand on the management bandwidth. And, in some sense, it is like allows us to build for long term as well as build for, medium term. In the trade generics, one has to be very very much on top of your receivables and inventory, and that requires management bandwidth. And so we are deploying our bandwidth as well as our capital appropriately, making sure that both these are not, none of them is lacking for attention or capital, so as to say.
Great. Congratulations on a good set of numbers. Thank you very much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Yogesh Tiwari from Arihant Capital. Please go ahead.
Yeah, thank you, sir, for the follow-up. So my question is basically around the inorganic opportunity. So given the cash flow we had about 60 crores in FY23 cash flow from operations, and given our balance sheet size, if you can share some more color on what sort of inorganic opportunity you will be looking at in terms of what would be the size like, and any specific segment like CDM or API, anything on those lines.
In terms of size, really, we do not have a restriction, because we, as you rightly mentioned, we generated 60 crores, and in spite of making payment on buyback, dividend, and the capex money that we spent, in spite of that, at the year end, we have solid liquidity position in place. In addition to that, we have zero debt, and there is obviously a debt generating capacity. So in terms of the size, really, we are flexible. The kind of opportunities that we are generating are manifold. We are open for acquisition in any segment for the right kind of opportunity. However, it has to be a synergic fit, and they have their. We don't want to fix many issues. We want to really have a good addition, and we are okay, we are okay being patient to wait for the right kind of opportunity.
And just to add to what Komal shared, basically, at least I have always believed that the business that we are in trade generics and the space of formulations that we are in, including CDMO, is not a cyclical business as such. Even through the uptick in COVID and downturn after COVID in pharma, we have continued to sustainably maintain our margins and perform. And while API is very different animal, and so something, at least you mentioned API, so I'm just responding that definitely, that's not a space that we are looking for. We are looking to do things, where if we can get a, shot in the arm by, something on exports or something on dosage forms, which are not with us. Injectable, we decided to build from scratch on our own because, we had to build something for future, and a modern plant is needed for that. So that's how we are looking at things. So other dosage forms are always there, and that's how we are being very, very careful that we do not adopt somebody's problem. And, it's good to adopt a challenge, but not a problem. So that's how we are thinking about the inorganic.
And just to continue on that, sir, what would be the any metrics, what would be the any targeted ROCE from the acquisition or any other metrics you look at before the acquisition or any valuation?
Really, it depends. So we would like to have strong ROCs in place, but it depends on the kind of opportunity. Honestly, we are also acquiring something that in the long term is building something for us, is a great strategic and synergy fit. So there is no particular formula that we are chasing. It depends on the kind of opportunity you wish.
Yes, and since we mentioned about injectables, so if we take about a 3-year view or maybe 3 to 5 year view, what would be the proportion of injectables to the overall revenue? Any target we have for this?
See, the injectable facility that we have built, typically in injectables, the asset turn of 1.2 to 1.3 is achievable. So, in terms of a full, and we have space on the second floor in this plant to increase capacity in the next phase. So my sense is that, currently what we have installed or what we are installing is going to take us to somewhere around 65 to 75 crores. And then we will, by augmenting capacity, we should be able to, cross about 110, 120 crores finally from this facility.
Sure, sir. And one question on the CDMO space, since that is the major space we have. So just to understand a little bit on the industry, are you seeing any pricing pressure when you negotiate with clients, because it is a very fragmented industry? So are you seeing any things of that sort happening in the CDMO business?
So what we are seeing is a pressure in terms of quality demand. The regulator has begun to really seriously enforce the very strong, whatever the Drug Act was originally meant to say. The new regulator is also there, DCGI. The new DCGI is there. He's very known in the industry for that. We are seeing actions against defaulting firms becoming very, very strict. So clients are also demanding much better quality standards, and it is actually, in some sense, playing out what we expected to play out a couple of years ago, when we talked about quality standards going up and potentially an opportunity for good players to outperform. So we see that, and that is mirroring in our efforts. We are getting some advantage also from that, and we continue to invest in our facilities to make them the best in class. So that is something that we are also continuing to do.
And sir, since in the CDMO space, the normal contract would be between 2 to 5 years. Any contract which is coming for renewal in the CDMO space?
No, Yogesh, see, I have spoken in the past about this. Typically, we have a contract which is a master services agreement, and in most cases is a 5 to 7 year agreement, and it keeps getting renewed. In some cases, there is no end date, and we have actually never lost a customer. In the last 21 years history of the company in CDMO, we might have said no to a customer because it doesn't work for us, it doesn't meet our ability to support them, but we have never lost a customer.
Okay, thank you, sir. That's all from my side. Thank you.
Thank you. As there are no further questions, I now hand the conference over to Ms. Komal Gupta for closing comments. Over to you, ma'am.
Thank you very much, everyone, for taking out time and to discuss the financial results of the company. I wish you
a great day ahead.
A great day ahead. Thank you.
Thank you.
Thank you. On behalf of Windlas Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.